I don't know about you, but I'm a little confused because last week on Wednesday, we received a rather dovish speech from Jerome Powell. Then on Friday, a hotter than expected jobs report. So what does this tell us about what to expect from the Fed next week?
Right. And so the Fed is doing something different. They've done something different the last year than typically they've done ever in history. They're trying to give us guidance. And, sometimes just like with analyst guidance, just like with company guidance, that guidance will sometimes be spot on and sometimes it will need revisions. At the end of the day, are we probably closer to the end of the rate rising cycle? Probably just past the midway point by my analysis. And by my analysis, and I think we'll start to hear this more in the coming weeks, the terminal rate's probably more like 6%. That's what that job report number showed us. And remember that Powell gave us his kind of Santa Claus assessment for where we were before that jobs number came in. Also, I believe before we revised the third quarter GDP number up to 2.9%. So where does that leave us, Seema? Well, it leaves us in a situation where we know that the Fed wants to combat inflation in a way that it doesn't become systemic in the minds of the public, where it doesn't become a structural part of our expectations. And so while I admit that eventually we'll go to higher for longer, we're not there yet. We're still simply on higher because we haven't accomplished that yet, as all these sentiment surveys point out. And so based on that jobs number, based on CPI, I think which will not show another meaningful reduction, I think we're going to see another 75 bips in the middle of this month.
What does that mean for the economy then?
Well, look, Powell has been pretty straightforward about this. We need to destroy demand for workers. We need to mitigate the strong demand for labor because we simply don't have enough supply. We're still sitting at about 1.7 jobs for every willing worker. And until that comes down, strong wage growth will continue to be one of the most poignant characteristics of this economy. And so they've been quite candid in that is their target. That, we saw unemployment still sitting at 3.7%. We saw participation tick down, which, obviously leads to further future wage growth. And so, without any meaningful impact on that so far, there's going to be more pain in the economy because they need to destroy the demand side for labor.
Talk about demand. Look at the story out of China, Greg. We have multiple cities across China loosening COVID-19 restrictions after those protests we saw last week. Chinese stocks once again surging at this hour. What's your read on this?
So it's an interesting development because at the end of the day, much of the crowd pointing to a dovish tilt for the Fed points to some of these global commodities like oil, seeing the price come in without acknowledging the global role that this plays. China is the biggest importer of oil. And so, we saw a very interesting OPEC meeting where they decided neither to cut nor raise and see what's going to happen as China opens up a bit. This is good for the global economy in that some of the recessionary forces will be beat back to bay a bit. But it also means that we'll probably see more inflation in some of the commodities, some of the metals, mining, which we've seen, some of the energy that we've seen, where people were hoping we'd get a reprieve and therefore put the Fed in a more dovish posture, which is, I think is likely not to happen now.